If you find that you have small amounts of money that are available to invest from time to time, you're ready for mutual funds. While you are working and earning money and trying to spend and lead your life the way you want to, there is another place where money is continuously borrowed, lent, used, turned, churned. There is a securities market, a live throbbing market for money that's happening out there. You need to get familiar with this market. Now, what is this market and what's happening here? There is government which requires money to pay salaries, or government is looking to borrow money to be able to meet its budgetary requirements. There are companies that are trying to raise money for their day-to-day affairs, or there are companies trying to set up big projects which will become huge global size projects. And then there are banks, institutions, small companies, big companies who are all searching for money for their big grand plans. The securities market is this big boiling pot of all of these issuers or people who are ready to pay for getting money to use. And here you are with small amounts of surplus, wondering what to do with it. You need to find a way to get your money to work in this market. Mutual funds are the bridge that will take your money, the small amounts that you have left unutilized, to go and participate in this big, large securities markets. The securities markets has three broad segments. There is the money market, there is the debt market, and the equity market. What is the money market? The money market is the place where very short-term borrowings between banks, institutions, and very large players happens. For example, the money that you leave with your bank, the bank takes it and invests it in an overnight market where it earns an interest rate on that money which it deploys there. So 1 day, 14 days, 3 months, 1 year, all borrowings up to 1 year happen in the money market. The debt market is also a market where various institutions, companies, government are all borrowing, but this borrowing happens for longer periods of time, from 1 year going up to 30 years. So companies that are setting up projects, governments that are trying to balance their budgets, institutions that are trying to build infrastructure, all of these are borrowers in this market. And then there is the equity market. Here you have good, bad, ugly, big, small, large, medium companies, all of these coming and telling you that you should buy their equity shares and participate in their prosperity. Now, the problem you have as the investor is that this is a large market. There are all kinds of borrowers and issuers here, and they are issuing papers of various kinds, various complexities. And you need somebody to select from these markets those securities that might be worth holding. Mutual funds do this job for you. Mutual funds are professional managers of money who are experts in the security markets. So all that they do is select and create portfolios from the securities markets. So a mutual fund would select a set of stocks which they believe are going to do well, and they will come and offer it to you as an equity fund. So when you talk of an equity fund, it is nothing but a portfolio of stocks which will be managed by the mutual fund. So whatever is the benefit from those securities, they will come to you. When you buy a mutual fund, what you're doing is you're engaging a professional investment manager who will buy from the securities market for you. And you pay this professional fund manager a fee, an annual fee. However, for the small amounts that you're investing, the manager cannot be creating separate portfolios for each one of us. Therefore, you will buy into a standard product with a stated set of objectives and a description of what will be done, and you participate in this product. So every mutual fund product will be investing in some segment of the securities market, and you will be earning the return that is available on these markets. So how will you invest in mutual funds? You will actually begin by opening a folio or investing a minimum amount which will help you open an account. In the mutual fund market, we call these as folios. Typical minimum investment amounts would be about 5,000 rupees. So look at these three segments. You have the money market, you have the debt market, and you have the equity market. So you need three funds. You need a liquid fund, you need a debt fund, and you need an equity fund. So you would invest the minimum amount of 5,000 rupees and get started. Once you have done this, whenever you have small balances which you think should be deployed in the money market for short periods of time, you keep transferring them to your liquid fund. When you think you have slightly longer periods of time and you can wait for about 6 months to a year, you have money that has come in through some sources, some your bonus or your sudden unexpected gifts from your relatives, etc. You want to keep this money until you decide what to do with it. You choose a debt fund and you are investing for the long term to ensure that your money appreciates. You put that money in the equity fund. So you have these three products and you keep transferring money into them and they keep getting invested and they would grow. And what their value would be will depend on a number the mutual fund will declare, which is called the net asset value or NAV. So NAV of a fund is available on every working day. What you will notice here is that your investment in the liquid fund will keep steadily moving up as it earns interest. You will find that your investment in the short-term debt fund is moving steadily, but there are a few small dips, but it recovers and keeps moving. Your investment in the equity fund, on the other hand, will move along with the market's ups and downs because equity as an investment is subject to higher amounts of risk. What you will find is that whenever you require money, assume you required money after a year. Now, which of these three funds would you access? You are likely to access your liquid fund balances and your short-term debt fund balances while you leave your equity money to lie as it is. So you will find that you are participating in the various segments of the market, you are investing money whenever you have it, you are able to withdraw money whenever you need it, and when you make these decisions, you have in your mind a certain time frame and risk. I want money in the short term, I invest in debt. I want money in the long term, I invest in equity. It is possible for you to make those small amounts that are with you to keep working for you in the securities market deployed with the help of a professional fund manager. That is the task mutual funds will do for you.